Hello, my name is Tim Hamilton, and I'm here to talk to you today about student loans and what you need to know in 2021. This presentation is part of the larger Planning on Call blog, podcast, and video series focusing on providing medical professionals and their spouses the important information they need to know as they plan their future. That said, I think today's presentation on student loans should help anyone with managing their student loans, no matter their profession, especially those that may have large student debt levels due to extensive postgraduate education. I'll also note that this presentation is going to focus on strategies to pay loans off versus the more broad topic of pre-planning that goes into how to afford college in general. For that interesting topic, we hope to have something coming out later this year. So before I move on, I just want to note a few quick things on me and my firm, Atlas Private Wealth Management. I'm a Senior Vice President and Wealth Management Advisor here at Atlas, and I'm also a Certified Financial Planner and Certified Student Loan Professional, among other financial designations. I've been working in financial planning for over a decade, and in my current role, I work with over 200 families, helping them plan their financial lives. As for my firm, Atlas, we're a fee-only financial planning firm based in New York, having formed back in 2014. We help individuals with financial planning, investment management, and tax preparation, and very importantly, we are a fiduciary firm and required to always act in our client's best interest. Lastly, I would also just like to note all situations discussed in this presentation are for illustrative purposes only. Numbers are estimated, interest rates are assumed, and each specific situation is very fact dependent. So you should reach out to an advisor to help with your personal situation. So with that, let's get into it. So the student loans overview I'm going to be doing, I'm actually going to break up into 3 different parts. So feel free to skip around to the section that may best apply to you. Section 1 is going to focus on a broad overview of student loans. Section 2 is going to focus on the student loan forgiveness program specifically. And Section 3 is going to present some case studies to show the effects of student loan planning in action. Right now, as I mentioned, we're going to focus this presentation on student loans on a broad level, and more specifically, terms you need to know, loan consolidation process, and then broadly, private student loans and federal student loans in general. To start out, I do want to talk a little bit about why this is important, and I'm going to do that by just rolling through some facts on student loans and giving you my interpretation of what those facts mean, and also maybe dispel some myths about student loans. So student loans right now are approximately $1.56 trillion in the United States. The amount of US borrowers is $44.7 million, again, approximately. And the average student loan borrower owes $32,731. The student loan delinquency or default rate is over 10%. And as of 2014, 42 million student loan borrowers owe less than $100,000. 3 million owe more than $100,000. And of that pretty large number, only 800,000 hold more than $200,000 in student loan debt. And as of 2016, only 14% of student loan debt is private student loan debt. The rest is federal student loans. And Black graduates are more likely to borrow and more likely to borrow more than students of other races. So my takeaways, first off, is that this is a widespread and pervasive problem among current graduates and young professionals. It's a national problem. 45 million people is a large percentage of this population, and 1.56 trillion is a big number. Furthermore, over 10% delinquency or default rate is pretty high. So this absolutely is something that we need to address. I will say, though, I do not think this is like the mortgage crisis back in 2008, which sometimes people will equate this to. The mortgage crisis, which was the worst economic downturn we've had since the Great Depression, was caused due to mortgage loans. Now, the student loan situation is a bit different. The average student loan debt, as I noted, is around $33,000. That's much less per individual than we saw in the mortgage crisis. Furthermore, student loan debt is predominantly already owned by the federal government, which again, in the mortgage crisis, this was not the case. Most debt was owned by private or semi-private entities. So really, as I look at this problem, I think its greatest effects are on two groups. The first group is usually marginalized members of the population that in many cases hold relatively small amounts of debt, but still lack the ability to pay it off. Now, there are a lot of proposals through the government to try to figure out how to deal with that. I will say that this presentation is going to focus on the other group of individuals I think student loans has an outsized effect on, and those are individuals that have very large levels of student loans, usually over $100,000 and $200,000. And those are usually brought on by a lot of advanced after-graduate education. Now, these individuals usually will be higher income earners and therefore will be able to pay off the loans at some point. But there are other very large impacts to these student loan debts. The first is looking at owning a home, also looking at starting a family, and in some cases, just becoming financially independent in general. So again, this presentation is really going to focus mostly on these individuals that I think do have larger levels of debt, again, usually due to advanced, longer amounts of graduate education, which are a relatively small amount of loan holders, but in terms of size, hold quite a bit in loans. So let's start out with terms that I think we need to know that will be helpful to understand as we go through the next the next part of this presentation, and then also the next two presentations as well. First, I think we should look at the difference between private and federal student loans. Private student loans are student loans from banks, private lenders, universities, states, or nonprofits. Important to note here, nonprofits, states, universities, these are offering what we classify as private student loans. This can be confusing because let's say that individual that may get their loan through a state university may think this is a government or nonprofit entity, definitely not private, therefore it's not a private student loan. That's not true. Private student loans are classified as anything that's really not a federal student loan. Federal student loans, ever since 2010, means that it is what's classified as a direct student loan and in the direct federal student loan program. That is what federal student loan debt is. And this distinction is very important, especially as we get towards the federal student loan repayment programs. Some other important things to know about debt and terms on how debt is used. One thing to classify as debt capitalization. So debt capitalization is debt interest added back to the principal of a loan, increasing the payments of the loan moving forward. So let's give an example of that. Let's say you owe $100,000 in debt coming out of undergrad at a 5% interest rate, and that would mean you owe $5,000 annually. Let's say you go back to grad school, stop paying on that debt, and during that time, $50,000 of debt accrues. If the debt then capitalizes, that means that $50,000 of accrued interest is added back into the principal. And now when you start paying, the amount you owe on an annual basis is $7,500, a lot more than the $5,000 it was before. So this can be very impactful, especially for individuals that may go to school for longer amounts of time. Another important term is grace period. This is a period before payments are required once a student falls below half-time status, usually 6 months. So if you are going to school part-time, know that if you fall below half-time status, you have 6 months before you have to start paying your loans. And then when you end school, you have 6 months to figure things out before you have to start paying. Another important thing to know is subsidized debt. Subsidized debt, going back to debt capitalization, this is debt that is not going to be accruing any interest while you're in school. And this again can be very impactful for individuals that may be in school for longer amounts of time. Subsidized debt is also not going to be accruing while you're in deferment. Deferment is something that you can put your loans into to stop or reduce your payments for up to 3 years. I would note that deferment is not something you see a ton of. It really is used in very specific cases, and there's really very specific reasons you can get into a deferment type of situation. What you see more of is forbearance. Forbearance is when loans are postponed or reduced for a certain amount of time. And it's important to note that interest is always going to be accruing in forbearance outside of certain exceptions, actually, like we're in right now due to the CARES Act and the coronavirus. But usually when you see forbearance, that means that loans are going to be postponed, but interest is going to accrue even on subsidized debt. Now, one thing to really watch out for is administrative forbearance. Administrative forbearance is something that loan administrators are very, very happy to put you in, especially if you have a question or you're trying to work something out and there's a dispute. They'll say, okay, we'll put you in administrative forbearance. You don't need to pay anything on this loan. But note, in administrative forbearance, you are going to be accruing interest through that period. So loan administrators are more than happy to do that and just allow the loans to get larger while they take their time to figure things out. So watch out for this. Last thing to note is default. Default does happen after 9 months or 270 days of delinquency, and delinquency starts on the first day of missed payments. Default is very bad. I think people know this, but when you do default, the full balance of your loan is due at that time, and heavy collection fees are assessed. So just be very, very careful for this. It's not something that is fun or easy to deal with. So let's start out in looking at loan consolidation, because this is where a lot of individuals start their loan repayment process. So loan consolidation is combining multiple loans into one loan and then repaying just that one loan. So there's two different types of loan repayment, loan consolidation programs, federal and private, and they're pretty different. So the federal program is, first of all, not going to include any private loans. You can't pull a private loan into a federal consolidation. The federal consolidation is always going to be into that direct federal plan. Also important to note that the federal consolidation is actually technically going to form two different loans. If you have subsidized and unsubsidized debt, you'll have a subsidized direct consolidated loan and an unsubsidized direct consolidated loan. Also, you can put as many loans, federal loans, as you want together. The interest rate on that will just be the weighted average of the loans that you're combining. And then again, everything that's going in here is going to be a direct federal loan, which is important, especially if you have what's called FEL loans, which existed before 2010, or Perkins loans. We'll get into what those are. If you have some of these other federal types of loans that especially may have existed in the past, when you consolidate, you'll be consolidating them into a direct federal loan. And this is going to be very impactful when we start looking at the repayment programs that are offered. Another thing to note that is important as it relates to loan repayment is that when you do consolidate, any loan repayment history that you had on that loan is going to be wiped away. So be very careful when you do that. Also to be careful about is private consolidation and private consolidation firms. So we're going to get into private loans. Private loans are really dictated by the contract, and contracts can be pretty murky with especially these loan consolidation firms. So you really need to know what you're getting into. Furthermore, know that if a federal loan is consolidated into a private loan, you will never be able to undo that. Or what I mean by that is you will never be able to take that federal loan and put it back into the federal system. Again, this is going to be very important when we start looking at repayment options. Another important thing to note about consolidation firms, regulators have really started to take a close look at these consolidation firms. So just be very wary if you have a firm that's coming at you to try to consolidate your loan. And again, especially if they're doing this, trying to tell you to consolidate your federal loans. You just really need to understand what you're getting into. And to better explain this, I think it's good to just speak a little bit now on private loans in general. So private loans, student loans are like any other loan. Private student loans are going to be based on an individual's credit worthiness, and the interest rate is also going to be dictated by the economic environment we're in and interest rates in general. So because a lot of time private loans are given to individuals that are really have no earnings history, very little earnings history, they're not going to have much credit worthiness. So either they're going to have to accept pretty high rates or very bad terms on that contract, or they're going to have a co-signer. It's also important to note that there's not as much flexibility in private loans in terms of repayment options, and there's not as many outs for things like death or disability. Also important to note is that private loans don't have the same type of protections if we hit times of economic distress. So as I briefly touched on earlier, we are in a period right now where individuals do not have to pay on student loans and interest is not accruing through a special, very special type of forbearance that came about through the CARES Act when the coronavirus outbreak happened. It's important to note that this affected all federal student loans. Private student loans, some private student loan vendors followed suit, but not all of them did, and they didn't have to either. So private student loans aren't going to have to allow a lot of the same protections that federal student loans offer. So because of this, all things being equal, unless private student loans are considerably lower in terms of the interest rate you're paying, usually like to start out by paying down the private student loans. So how do we investigate private student loans? First place to find where all your private student loans would be to look on your credit report. Everything should be listed there. If you have a private student loan that you want to investigate specifically, go to that loan provider and request a promissory note. Promissory note is a record from the lender or servicer detailing all the important information within the loan. And the important things to look at in a private loan are interest rate. So interest rates can be variable, they can be fixed and then variable, they can be ballooning. Again, it's all based on the contract that you're signing. Every loan can be different. So make sure you understand how that interest rate works, what it is, etc. Does it capitalize? Another very important thing to look at. Again, capitalization can be something that really does hurt long term. Co-signer. So is there a release provision? So if your parents sign on that, can they ever get out of that loan? If something happens to one of the co-signers, is there what's called a default trigger where the loan automatically defaults or maybe accelerates payments? And then also death and disability discharge provisions. Federal student loans does allow for forgiveness of loans under death or disability. Private student loans, this is not always the case. And again, it's dependent on the contract. So these are things that you really want to look at when you're looking at private student loans. So how do we repay student loans? How do we be efficient about this? First thing to consider is that just in general, private student loans do not have nearly the same amount of repayment options as federal student loans. So again, I do just like to try to focus on private student loans first, all things being equal. I also always like to mention that as it relates to private student loans, focus on, and really this is a way to think about any loan, but focus on the loans with the highest interest rate first, and then just pay the minimum on the rest. So if you have a 8%, 6%, and 5% loan, focus on paying as much towards that 8% loan until it's paid off, then the 6% loan, and then the 5% loan. And in that way, you'll be able to pay the loans off as quickly and efficiently as possible. And the other thing you can always look at with private student loans is refinancing. So refinancing is just basically going back to the loan servicer you're with or a different loan servicer and asking for a lower rate. And when you want to do that is when we're in a low interest rate environment like we are right now. So in general, interest rates go down, you may be able to get a lower rate. And then also when you have established yourself in your career, a lot of times this means you're going to have better credit. You're going to have a lot more income. So in this case, the loan, a loan servicer provider may say, okay, this person I think is a lot more credit worthy, and therefore we'll refinance them at a lower rate. You can also do this by bringing in a cosigner as well. So that is really the options I would look at with private loans. And the last thing I'll say about private loans is there's just, again, a lot less options. We're going to do a lot of the focus through really the rest of this presentation and both presentations on the federal student loans, because there are a lot more federal student loans out there and more repayment options. So federal student loans. Federal student loans are, as I mentioned, all through the direct system now. You have direct student loans for undergrads that are known as Stafford student loans. Stafford student loans are broken up into subsidized and unsubsidized debt. Subsidized is only going to be need-based, and both for subsidized and subsidized in the undergraduate Stafford loan program, there's only so much you can get despite whatever your tuition and payments are. You also have direct grad plus loans. Now, these loans are not need-based, and furthermore, they're up to the full amount of tuition for that grad program. So this is where you can see federal student loans get very large. And again, looking at individuals that have 100, 200, 300 plus $1,000 in student loans, these are individuals that go through extensive graduate education, many times in programs that are pretty expensive. So doctors, lawyers, etc. Direct Parent Plus loans, these are loans that are offered to the parents. Important to note with this is that Parent Plus loans are owned by the parent. These are not something that's going to someday be rolled into the kids or tied to the kids in any way. These are loans that the parents are taking off and the parents need to repay. Perkins loans, you don't see too much, but these are provided to individuals with exceptional financial need. Furthermore, I would note with Perkins loans, they have a set interest rate of 5%. The direct program is going to have variable interest rates that's tied to the 10-year treasury plus a certain percentage on top of that, and they are capped. Undergraduate Stafford loans are capped at 8.25%. Graduate loans are capped at 9.5%. And then graduate and grad plus loans as well, whereas parent plus loans are capped at 10.5%. The last loan I would just want to note is the Federal Family Education Loan, FFEL loans. Now, these have not existed since 2010, but especially for individuals that were in school before 2010, you will see a lot of these. I just want to note that if you do want to consolidate these, you can get these into the direct loan program, and this will have a big effect as we look towards the federal repayment options. So, federal repayment options. Standard repayment for a federal loan is 10 years, and that's going to be the same monthly payment over 10 years. At the end of that 10 years, the loan will be completely repaid as well as the interest. If you consolidate your loans, given the amount that you're consolidating, you will have a longer repayment period. If you owe over $60,000, your loan repayment will actually be pushed all the way up to 30 years. Graduated repayments, this is also a 30-year repayment program, but you will start out with smaller payments and that will grow over time. Extended loans will allow you to have the same loan repayment, but push that loan repayment period out 25 years. And just to note on these longer repayment periods, be careful. Any of these 25, 30 years, you're going to be paying considerable more over the long run. So you really do this when you really need some flexibility early on, right after you get out of school. Another thing to note about these standard repayments is that they do not negatively amortize. So what that means is that you're never going to have a payment that is not going to cover the interest. Therefore, the loan will not grow over time. At the end of whatever the repayment period is, the loan will be zero. Now, this is very different than the next type of repayment plan, the income-driven repayment plan. Income-driven repayment plan is based on your income, not the size of the loan. Therefore, if you have a lot of loans, large amount of loans, and let's say also pretty large interest rates, either or both, it's very, very possible that you may be making an amount that means you are not even covering the interest on that loan, which means the loan is going to grow over time. These income-driven repayment plans can last 20 to 25 years. They can be based on paying between 10 and 20% of your discretionary income. And there's several different types of these plans, and it can get really complicated, which is why we're going to spend the entire next presentation focusing on these plans. The other really important thing to note about this, though, is that IDR plans will, in the standard way, at 20 or 25 years, when the loans are forgiven, whatever is forgiven will be taxable to you. So let's say you have a $100,000 loan and that grows due to negative amortization up to $300,000 after 20 or 25 years. When those loans are forgiven, you now have basically an income bomb going off of $300,000, and you will have to pay taxes on that $300,000. So that is absolutely something that you will need to plan for. Then the last thing to note as it relates to repayment of federal student loans is kind of the golden ticket here, the Public Service Loan Forgiveness Program, the PSLF program. This is a program that is allowed to individuals that are working either for a government entity or a qualifying nonprofit, and for individuals that work there for 120 qualified monthly payments or 10 years. We'll get into this in a lot more detail, again, next presentation. But the reason this is so great is that your loans are forgiven not only in 10 years instead of 20 to 25 years, the loans that are forgiven are not taxable. So the loans are just gone. You don't owe any taxes or anything like that. And because of that, it's very, very, very impactful. So we're going to dive into that in the next presentation. And especially if you are an individual that, let's say, may be going to residency and working at a hospital, which is a qualifying nonprofit, and then maybe are going to be an attending after that at a hospital, you can very easily qualify for this program, and it can be very, very impactful to you, especially through those leaner years where you're making less, like in residency. So for individuals that may fall into being able to take advantage of the PSLF program, I really, really encourage you to listen to the next part of this presentation. But with that, I will end today's discussion. Thank you very, very much for watching and or listening. Feel free to reach out to me with any questions. I do have my information up here. And also, if you need anything, don't hesitate to go to our website, atlaspwm.com. And please don't hesitate to check out more Planning on Call material. You can find Planning on Call material under the Resources tab and Planning on Call at the Atlas website. So thank you very much for listening to me, your on-call financial planner, and I look forward to you tuning in to future video, blog, and podcast releases. Thanks a lot.